There's a lot going on in the markets these days. It's called market crosscurrents, conflicting forces that are creating volatility and uncertainty. This includes earnings season, durable goods, GDP, and PCE. That's this week. A surging housing supply, geopolitical events, a contracting inverted bond market, and a Federal Reserve pending decision. Starting off, the Fed futures are predicting a quarter point cut every month starting in December through December. Here we see in blue, that's the current Fed funds futures at 5.25 to 5.50. Right now, for the July meeting, there's a 94% chance the Federal Reserve is not going to cut rates and keep them unchanged. There is a 6% chance of a cut. Moving to the September meeting, there's a 90% chance of a quarter point cut. In the November meeting, there's a 56% chance that will be 50 basis points, half a point lower than we are here. And by December, there's a 53% chance that will be 3/4 of a percentage point lower than current rates. So the Fed futures are telling us the current momentum is looking for lower rates. Here's the Fed funds futures today. Now, if you have watched, the stock market was very weak today. Along with this weakness, we saw the anticipation that the Federal Reserve would cut rates that accelerated throughout the day. Here we see in the July meeting, it rose 2%. That's the probability the Federal Reserve will cut rates in July. They're most likely not going to, but it leaned more in that direction. As far as the September meeting, there's more of a movement now towards a half a point cut. Now, most likely they're not going to cut by half a point, but the point is that we saw a growing anticipation, a leaning more towards the side of lower rates. For the November meeting, we're moving more towards the possibility of a half a point to even 3/4 of a point cut. And by the December meeting, the money moved more in anticipation of lower rates. So over the course of the day, we saw the Fed funds futures move more in the direction of lower rates. Now, the inverted bond market is also contracting. This is all happening at the same time. This is a current daily change. This is how the Treasury market changed today in terms of yield. And what you'll notice, the short-term maturities on the left-hand side, 3 month, 6 month, and 1 year, those yields went down. Long-term maturities like the 10 and 30 year on the right-hand side, those yields went up. So we see short-term maturities down, long-term maturities up. Well, in blue, that's the 1 year. That's short term. That's trending lower. The 10 year is a long term. That's trending higher. So we're seeing that the 1 year is moving lower. Now, currently, the 1 year still pays a higher yield than the 10 year. But that spread, that inverted spread, is contracting. It's starting to go away. In red, S&P 500, very weak today. In white, the 10-1 spread, that's the 10-year, 1 year U.S. Treasury spread. And it's in negative territory, but it's heading higher. What you'll notice, an inverted bond market. As the spread contracts, as the inverted bond market continues to move towards the direction of zero, of not being inverted, the stock market is weak. Now, as Fed funds futures and the treasuries are both predicting lower rates, we know this because the 1 year is going down and the Fed funds futures are going down. Here's the question. Is this a result of the anticipation that growth is going down, declining, or is inflation declining? We may have the answer for both of those this week. Later on this week, GDP, gross domestic product, is scheduled to be released following last quarter's 1.4%. If this comes in shallow, if we see a weak GDP, basically 1.4% was not good. If we see this in a 1%, even almost 2% area, that would indicate the economy is slowing, that growth is slowing. We also have this week PCE, personal consumption expenditure. The last number was 2.6%. Now we want inflation to come down. In either case, the Federal Reserve has more of a probability, more likelihood to cut rates, either as a result of growth of the economy slowing down or of inflation slowing down, or maybe a combination of both. But the way we slow down determines whether we see a soft landing or a hard landing. Now, alongside this, we have stock market news. Lots of earnings are starting to come out, and a lot of them are not good. This is the worst day we've seen in quite a while. In white, S&P 500. Below, that shows us the percentage change on a daily basis for the S&P 500. Today, the S&P 500, it was down 2.3%. That's a big decline. How big? We have not seen that significant of a decline since December of 22. That was at what, 2.5%. That's a pretty significant decline, and we know that when volatility comes back to the market, it's usually accompanied by more volatility. By the way, we posted the other day part 2 of our custom recession indicator series. That involves the housing market. We had new home sales today. Supply is up. We discussed how the acceleration of supply is an early precursor, oftentimes, to a recession. So certainly today's increase in supply, it's not awful, but it's not going in the right direction either. And in this video, we talk all about the thresholds we need to see in order to determine whether it's a recession or not. We hope this has been helpful. We look forward to seeing you back.